This podcast is sponsored by SoFi to help you get your money right and is for informational purposes only. Nothing in this program is a recommendation from SoFi to you or any listener. You should not rely on this program for any financial advice or legal or tax advice. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates. SoFi makes up about 5% of ARK's FinTech Innovation ETF portfolio, but ARK Investment Management holds a little over 1% of SoFi's outstanding shares.
This is The Important Part. I'm Liz Thomas, Head of Investment Strategy at SoFi. My guest today is Cathie Wood, founder, CEO, and CIO at ARK Investment Management, LLC. ARK's funds are known for taking big bets on disruptive innovation, meaning tech companies at the forefront of innovation in areas like AI, BioTech, robotics, and cryptocurrency. In other words, technologies that can potentially change the world. Cathie founded ARK back in 2014. She started her career at the Capital Group and has spent time at Jennison Associates, LLC, and AllianceBernstein. She also previously co-founded the hedge fund Tupelo Capital Management. Cathie, welcome to The Important Part. Thank you so much for joining me today.
Oh, very happy to be with you, Liz. Thank you for inviting me.
So let's start at the beginning. You founded ARK back in 2014 with a focus on innovation from the jump. People can define the word innovation very, very differently.
Yes.
And in today's world that is dominated by technology and all sorts of technological themes that we will get into in this interview, I think what would be useful just to lay the groundwork is tell us how you define innovation at ARK.
Right. Well, we define it. It meets three characteristics, and we describe these as innovation platforms. One, they follow a learning curve, which means costs fall over time. That's the critical one. It's the starting point. And so they are technologically enabled. Technology is deflationary. So that's the first one. The second is they cut across economic sectors. This is also important because technology is now permeating every sector, every industry, every sub-industry, and it's actually starting to blur the lines between and among industries. And we saw that, of course, when the GICs against which we measure performance of various sectors had to split technology into communication services and technology because initially Facebook, which it was called at the time, Google, Amazon, all of those, or some of those were in the technology space, but they were becoming much more advertising centric. And so they had to split them apart. I think that's going to happen more and more over time. So declining cost curve, cutting across economic sectors, and then these innovation platforms serve as launching pads for more innovation. And so an example of that is DNA sequencing in the multi-omic space, we call it. It's life sciences, healthcare. If we weren't able to identify what was going wrong in our genome, thanks to sequencing technologies, we would never have been able to invent gene editing to fix those problems, just to give you a sense. In terms of the 5 innovation platforms themselves, they are multi-omic sequencing, I just mentioned that one, robotics, energy storage, artificial intelligence, and blockchain technology. And the final thing I'll say about them is they all meet those 3 characteristics. But what makes this new world so exciting is they are converging with each other as well. So, in the world of innovation, we talk about S-curves. What's an S-curve? An S-curve in innovation is slowly, then all at once takes off. A new technology takes off. Well, think about 3 S-curves feeding each other as they are in autonomous taxi networks, robotaxis. That That is the convergence of robotics, autonomous vehicles are robots, energy storage, they will be electric, and artificial intelligence.
Okay. And we'll get to this later in the interview. I imagine in today's world, in today's market world, we've got this trading mentality and everybody wants results tomorrow, right? They buy a stock today, they want the result tomorrow, if not maybe next week, but we're certainly not going to wait longer than that for the result. If we're thinking about it from an innovative perspective, it's feeding into this, I'm going to call it an innovation tunnel where everything sort of converges and then builds the innovation even more to scale afterwards. That takes time.
Yes.
And I'm just sort of teasing that for later in the interview with something that we can get a little deeper into. What I found really interesting when, before this episode, doing much more deep research on you as an investor, is that you have a background in economics, which I'm guessing most people don't really know. So tell me about how the background in economics feeds into your investment philosophy today.
Yes, I think in a few ways. What have investors been really worried about in the last few years? Inflation, and therefore interest rates.
Right.
We had a very strong point of view on what was going to happen to both in the last few years. We did think that the surge in CPI, so consumer-based inflation, to 9%, was going to unwind. And here we are at roughly 2.5%. And based on what I just told you about the technologies we see evolving and actually becoming needle movers when it comes to inflation, we think inflation is going to continue to surprise on the low side of expectations. And therefore, interest rates will be lower than many people have feared. That's an important call for our kind of strategy, which is long-term in nature. Interest rates help us figure out what we should pay now for a given stream of cash flows. If interest rates go up, we pay less. If interest rates go down, we pay more. So that's a very important economic concept. I also, as an investor, have felt because so many of the concerns on a day-to-day basis have to do with economics. We get economic statistics reported every day. That's a constant feed on the various news stations and on the various websites. That to have a point of view is important to allay fears or to actually agree with them and say, hey, we agree with you. This is risky and we're going to take risk out of the portfolio. Now, we have a long-term time horizon. We're not trading around economic statistics at all. In fact, our investment time horizon is 5 years. So we'll often look at something which we believe is short-term in nature, as this inflation surge was. And we will lean into it saying, okay, well, this is going to change. And we think investors are going to worry less about it. And that the stock market will therefore do much better than many people fear.
So I want to go back to a couple of things you said in that answer, just for our listeners' benefit. You mentioned interest rates and how they affect basically what we pay for in the future. A lot of times we refer to that as a discount rate. And
right.
the way that you do that mathematically is that the discount rate goes in the denominator of the fraction. So if the denominator is smaller, the result gets larger.
Yes.
And you hear that talked about a lot in media, the discount rate of such and such stock. And the reason it matters is because what people are willing to pay for that stock today changes if the discount rate changes.
Yes.
And to your point, it is an important call to say that rates might be lower than we expect them to be, because we're in an environment right now where rates have risen considerably in the last month or so. And a lot of the speculation, I would even venture to say consensus expectations, are for rates to stay elevated. So that is an important call. The other thing that I think is important to remember, And I say this all the time. I mean, I spend a lot of my time on macro data. I spend a lot of my time on the economy and what it means for capital markets. And some of the criticisms of that are from, let's say, what we would call a bottom-up stock picker, who would look at things and say, all that really matters are the earnings of the company. All that really matters is whether or not the company has a good competitive position, what the competitive environment is. That's certainly important. But I've always thought, even if you are a bottom-up stock picker, you have to know what environment you're picking those stocks in. And the way to understand that environment, the way to understand, let's call it the weather pattern of when you're picking these stocks, is to look at the macro data and understand not only what's going on right now, but have a view of what you think might happen in the future. And right now, what we're dealing with is what might happen in the future is a new administration that could change policies quite a bit and change that environment quite a bit. So what would your broad take on the economy be today?
Well, let's start with interest rates. I think one of the reasons for the backup in interest rates is many investors fear an explosion in spending, given all of the election year promises. To take a point of view on that, based on our knowledge of Elon Musk and Vivek Ramaswamy, we think that the Department of Government Efficiency, clever, Doge. Yes, we do think that's going to be successful. And one of the reasons is technology, especially artificial intelligence. And I think they're very serious. We're excited about the government efficiency. You know, government spending is taxation. You're either going to be taxed now, they're going to raise taxes now to defray it, or in the future, so that could be our children, or inflation. Inflation wipes away debt. It lessens the burden of debt, but it's a horribly regressive tax. So we think this deficit reduction is going to happen both because of the government efficiency moves and because we believe economic growth, once we understand what the policies are and once they are effective, I think any tax cut that they put in place has to be retroactive to the beginning of the year. Otherwise, you're going to have deferred activity. And we feel we've been in a rolling recession for the last 2 years since interest rates shot up, with housing down, autos very weak, commercial real estate very weak, capital spending now falling. The consumer is holding things up, and mostly the high-end consumer. So we've got a lot of cyclical sectors very depressed right now. And if we get clarity on these policies, then I think we will have a very strong recovery. It may take until the second half of next year, but I think if they make policies retroactive, we won't need to fall into a recession. This reminds me very much of the Reagan years, very early in my career. The biggest mistake that Reagan made was phasing in the tax cuts, and everybody waited for the lowest tax rate. So I don't think they're going to make that mistake. So we do think there will be a strong economy. And we also believe that productivity is going to be much stronger than many investors expect. Most of this is because of technologically enabled innovation. AI, of course, artificial intelligence, is the biggest catalyst to probably the biggest productivity gains we're going to see in our lifetimes. Right now, productivity growth is 2%. We think that productivity growth could go north of 4%, 5%, really going back to the 90s when we had a surge in productivity. And it could go even higher depending on the policies. Productivity growth will also be an anti-inflationary force. Wages can go up 4%. If productivity is up 4%, then unit labor costs are zero. So we're very enthusiastic about that concept. And, I know a lot of people worry about a resurgence in inflation. They think about the deficit. But I would submit, based on what we see going on in the world of technology, from venture capital now that is going to be freed up thanks to deregulation, innovation broadly freed up, especially in healthcare. I think that's probably the most misunderstood sector in terms of the impact of technology moving forward.
Okay, I want to clear up for anybody who's listening that's confused about the tax conversation. So we're thinking about the possibility of tax cuts that the new administration might get through, let's say towards the end or in the second half of 2025. So when we're talking about a retroactive period, it would be back to the beginning of 2025, not back to the beginning of 2024. I just want to be clear about that with everybody.
Oh, absolutely. And when I say that, the quicker they communicate that, even if the policy isn't in place, the better off we will be.
So if you ask really any investor or any person, I think at this point, what's the most innovative thing that's going on in the world right now? I am willing to bet at least 80%, if not 90% or more, will say AI. And it has become pervasive in conversations. And I think most people understand that it's here. We're trying to figure out exactly what to use it for, exactly where the profit is coming from. If I'm thinking about the ARK Innovation ETF that you run, you've already referenced AI a few times and that you think it's going to be a productivity benefit. There's all sorts of things. There's still a lot to come in the space. Yet many of the buzzworthy AI names that shall remain nameless here, I suppose, but the buzzworthy AI names are absent from that portfolio or have been absent for the better part of this year. And I'm sure you've taken a little bit of flack for that, perhaps a lot of hard questions on it. So tell us, has that been a decision thematically? Has that been a valuation decision? Has it been a risk management decision? And then maybe how would you play the AI space today?
Sometimes cyclical analysis can hurt. If you look at the semiconductor industry broadly, it has not done well recently. It has been hurt badly, except for NVIDIA and the special few. Our thought process at the time was, all right, NVIDIA is surpassing $2 trillion. And we do own NVIDIA, I should say, in ARKW and some of our more specialized portfolios. In the flagship, our thought process was, all right, NVIDIA, $2 trillion in enterprise value, or now $3.5 trillion. Okay, that's wonderful. It's been a great stock. And we were so early on this stock. We bought it at 40 cents on the dollar in 2014. Wow. So now it's nearly $150. So, and we do own it in many portfolios. So we were very early. And as it was escalating into the trillions, we bought it at 6 billion. As it was escalating into the trillions, we were saying, okay, this is a signal that AI is going to reach deeply into the global economy and is going to impact many, many other companies. Otherwise, why would it be worth that much?
So I'm going to paraphrase and tell me if I've got it right. The fact that there were certain buzzworthy names that were absent from the portfolio or from your flagship portfolio wasn't a call against AI, wasn't a call against a certain name. It was trying to identify what other industries, what other companies might benefit from this theme that you thought was still really quite in its infancy.
Oh, it is.
And understanding that maybe a couple of those buzzworthy names or even the semiconductor industry overall was just emblematic of how this theme might take off and be pervasive through many things. So then trying to position the portfolio to benefit from that next step.
And to give you a sense of how we think about that, there are 4 criteria. We're looking at companies. Almost every company in the portfolio we view through an AI lens because that is the most important technology platform shift in history. And so what are the 4 criteria? Each company, and because it's going to sweep throughout the knowledge worker industry, we think the productivity gains are going to be huge. And so you're going to see that in every company that focuses on AI correctly from our point of view. 4 criteria. They must have deep domain expertise. And I'll go back to healthcare again. That is an area. Biology is one of the most complicated areas in which we invest. So we are looking for companies with deep domain expertise, taking AI seriously, either hiring a Palantir or hiring their own engineers and focusing them more directly and exclusively on AI. Global distribution, either with partners. This is going to sweep through the world pretty quickly. And then the most important one after those three is proprietary data. Companies that have data that no one else has can create new products and services that others cannot. And so that also is very important to us. So we're not looking at AI as a few stocks as beneficiaries at all. We're looking at every company potentially benefiting. Just depends how aggressively they harness these new tools.
Which is a different mindset than I think the market and maybe media has framed AI in the sense of, it seems to me like everybody's out there trying to pick the winners.
Right.
And choose those one or two stocks that are going to be the godfathers of AI for decades to come. And look, maybe that does work. Who knows? But I think that this still is an early theme, and themes in general take at least 2 to 5 years to play out. And what we've seen already in the market reactions to earnings of a lot of these companies is that all of the enthusiasm and the optimism was pulled forward. We had all of this spend on AI, and it pulled forward the optimism, which is fine. I mean, that's what markets do. They price things before they happen.
Yes.
But now we're entering this era where companies are being more scrutinized for the spend. Now you've spent all this money.
Yes.
What's to show for it,
Exactly.
right? Where's the profit? What's the use case? Where's the productivity? What does it add to the bottom line? And the bar has gotten higher and higher every earnings season for companies to not only beat the expectations for their results on revenue and earnings, but they have to raise their guidance. And they don't have to just raise their guidance by a little bit. They have to raise their guidance by a lot in order for the market to really reward them. It's almost as if they have to surprise to the upside in an exceptional way to be rewarded by the market now. And look, maybe that's a more rational way to look at this now. If it is so revolutionary, then it should start to produce results sooner, or it should start to produce profit. And maybe investors should be more critical of how much we're spending. Is that a fair characterization?
Definitely. I also think one of the reasons for what you are saying, Liz, is that the market's multiple by historical standards is quite high, depending on the metric you use, low 20s. And so there's less room for error, shall we say, if you're looking at valuations in a historical context. Now, we believe there are going to be some transformational business models out there. We often describe Tesla as the largest AI project on Earth, and we do believe that. We describe what's going on in healthcare when it comes to AI as the most profound application of artificial intelligence, because we're going to be diagnosing cancer in stage 1 or before stage 1, now that the convergence between sequencing technologies and AI are coming together in molecular diagnostic tests, which are effectively blood tests to figure out if we have cancer. We'll have regular blood tests and we'll diagnose cancer way earlier than we do now. And then when you add to that CRISPR gene editing, in other cases, we'll be curing diseases. So this could not happen without artificial intelligence. I think when you are talking about the companies that where investors are saying, wait a minute, you are spending hand over fist on GPUs and the cloud generally, you're talking about what many people call the Mag 6 that benefited so beautifully from the concentration that we saw in the market, or that we have seen since for I would say almost 10 years. It started 10 years ago, and it, I think, reached a crescendo recently in the so-called Mag 6. Many of them are, I mean, I know Microsoft's capital spending budget has gone from, I think, 30 to it will be 60 in 18 months, something like that. And when investors don't see the needle moving much on the top line, they say, wait a minute, what is that all about? So I understand it, because they were the biggest beneficiaries, and their valuations, or PE ratios, if you want to describe it that way, are much higher than they have been historically. And all of them got to the top of the heap in terms of this concentrated market move because they had huge cash hoards, and interest rates, at least relative to recent history, were very high. And most people thought, oh, these must be the prime beneficiaries of AI, which they may or may not be.
Right. So it's still going to be affected by AI. But what's an area that you're most excited about from an innovation perspective, let's say for the next 5 years? You mentioned 5 years as a holding period. What industry do you think gets affected the most in a positive way?
There are two. One is transportation. So autonomous mobility of all kinds. So not just robo-taxis, but drones and air taxis. Drones, I know that Walmart is piloting a test with Zipline, which is in our venture fund. And they're trying to get packages. This is in the Dallas-Fort Worth area, trying to get packages, I think, below 8 pounds from Walmart's to homes in the Dallas-Fort Worth area, within a half hour or whatever of the order. And from our research, we believe that drone transportation of whether it's groceries or other consumer products, can be transported at a much lower cost than people now understand. I think when we see this happening at scale throughout the United States, we believe that the average package could be delivered for something like 30 cents, as opposed to the delivery fees when we are getting our food now. For example, they can be as high as the food itself. That world's going to change. And it will also alleviate the congestion that we think we'll see on the roads. And it'll be increasing congestion because we think robo-taxi rides are going to fall in price. Again, the technology helping us there as well. I'm going to keep coming back to healthcare because it is the most undervalued, most inefficiently priced, and most misunderstood area of the market that's going to be impacted by all kinds of innovation. AI, I mentioned the sequencing technologies, CRISPR gene editing. We're going to see cures for disease. We're already seeing them for sickle cell disease and for beta thalassemia. CRISPR Therapeutics is just rolling that out. It's been approved, it's been reimbursed, and it's on its way. The model here is so different from the model that traditional analysts and investors have been used to, that it's just like with Tesla on autonomous taxi networks, which we have put into our model, but most analysts have not. It's the same thing with healthcare. Many healthcare analysts think that curing a disease is not going to be good business, even though it's amazing for humanity. They think that a cure is one and done, which it is with gene editing. But the old model is almost like an annuity, a regular payment monthly for that prescription out for however long the patent lasts. We believe that a cure in business terms is going to be worth 2 to, depending on the indication, as much as 20 times. It will be 2 to 20 times more valuable than a traditional medication. So stay tuned for our research. We're putting out a lot in that area because we believe it is so misunderstood.
So it takes a long time and it takes a lot of patience to be an investor, particularly in innovative themes. How do you stay long and strong through market turmoil, through a market that views an investment time horizon as, I don't know, 30 days sometimes? It feels like we're in such a trading mentality today.
Yeah.
And likewise, how do you stay long some of these themes if in the short term it doesn't seem like they're working and you're taking a lot of criticism for it?
Well, I've been around for a long time.
Experience helps.
So I've seen many cycles, including the one that started in 1995. And it started after a period much like what we've just experienced. Interest rates and commodity prices had soared. The Fed had gotten really tough. This was in 1994. Growth stocks had been pummeled, and it was a very difficult market. And then what happened? The internet age clicked. And this is why we give our research away. We want to help that click happen for people, that aha moment. Because once it clicked, now many people aren't going to know who this is, but Brian Gumbel and Katie Couric, I remember in the early 90s saying, what is this thing called the internet? What is it? Like, they couldn't get their heads around it. Well, in 1995, more and more investors at least got their heads around it, and they began to extend their models to see, press them. How far could this go? How far could this take us? And they came up with some incredible numbers. And so the 95 through 99 was the golden age of the internet. Unfortunately, that went too far, and it's affecting investors to this day. We had after it the tech and telecom bust. Because of that experience, many investors are fearful of technology and anyone getting too excited about technology. I actually feel very good right now that the market, except for a few stocks, as we've discussed, the market really is not focusing and hyping all of the companies that are going to benefit. I feel much better now about our portfolios than I did at the peak of our performance in early 21, when everybody assumed that we were here in a new age. The future is here, global digitalization, personalized medicine, and they were throwing money at the market. We're in the opposite situation right now, certainly with our strategies. And yes, does it take some gumption to stick to them? The courage of our conviction is from our research. Our research is first principles based. We do not look at any benchmark to give us our ideas. We take a white sheet of paper, first principles look at any new technology that is happening out there. How did we find NVIDIA and build it so aggressively in 2015? It was because we took a white sheet of paper. Brett Winton, our director of research at the time, said, okay, Tasha Keeney, go out and figure out what an autonomous vehicle, what is Elon Musk talking about here? What is an autonomous vehicle? And she came back and said, it appears that the brains or the central nervous system of an autonomous vehicle are going to be GPUs. And I said, what? Because at the time, GPUs were nothing but PC gaming chip companies. And PCs were dropping at a double-digit rate. So our research gives us the courage of our conviction. And of course, when the market is working against us, we will redouble our efforts and saying, okay, wait a minute, have we made a mistake in some of our assumptions here? Have we made a mistake on what a cure is worth here? Because these stocks, CRISPR Therapeutics, Intellia, others, are not behaving like we have cures on the horizon, and that they are going to be worth a lot in terms of market value. And we haven't been dissuaded from that point of view, but it has been the toughest part of our portfolio, no doubt about it.
It takes a thick skin, and I think it takes a strong stomach. I want to talk about venture capital a little bit. just to close this out, I would put it right now where we are in the venture capital cycle. I mean, obviously there's venture capital and what it means to an investor, which I'd like you to define for our investors. But it also falls in the category right now of vehicles that have democratized investing. So it used to be that venture capital was only available to private investors, very high net worth investors, maybe institutional investors, because there were these really high minimums. But the industry has come a long way. And now we've got different vehicles where the everyday investor with much less money can get exposure to things like venture capital. So you manage a venture fund at ARK, which we offer on our platform at SoFi. How would you describe venture capital to a beginner?
One of the reasons we started this venture capital firm is because one of the questions we got from our clients, many of whom are very young, they basically came to us and said, how is it that we know so much about these technologies that are starting to evolve in the private markets? We know more, probably, and it is probably true, than some of these institutional investors because they're passionate about it, right? And how is it that we can't get access to those companies because we know they're going to work? And I began to think, this is un-American. It's absolutely right. They should have a shot at this by all rights. They'll be big supporters of these companies and the technologies. And so we started our venture fund. It's an interval fund. And our clients can gain access to SpaceX and Epic and Discord and Databricks and Freenome and names that people know very well and some they don't know very well for just $500. And that was very appealing. It's a 40 Act fund, meaning it's SEC regulated. So it's like an ETF or a mutual fund. And so therefore open to retail investors. It's a higher fee than we would charge for an ETF, but there's no so-called carry. In traditional venture, the clients pay, it's typically 2% management fee, and then they pay 20% of whatever profits come off of these companies. We don't charge that 20% of the profits. And so venture is in the private world. These are startups, typically innovation focused. That's why it's also very attractive to us. Typically technologically enabled innovation. And we had been analyzing these companies, even though we didn't have a fund, because they are the future competitors to companies in the public markets. They hope to transform the world or disrupt the world in some way by offering something that will fulfill an unmet need. Very often that's the case, solve problems. So we're very attracted to this because this is our research. It has led us to the private world. And I think if we're right on what's going to happen here with regulations have just been a noose around the neck of venture capital in recent years, mostly because of the FTC. The FTC, Federal Trade Commission, was not allowing mergers and acquisitions. And this is a huge area called providing liquidity events for these companies. Very often they're starting up, but they are not going to be able to distribute around the world. They can't. They're too small. They don't have the wherewithal, and the private markets won't fund them. And so they will gladly become a part of a company that does have global distribution. But that hasn't happened. So a lot of M&A hasn't happened. We think that's going to change with this new administration. We're really excited about the prospects for innovation generally as deregulation comes down, tax rates come down, incentives increase, animal spirits increase. So I think this could become the golden age again for venture capital.
Is that the ideal path to success for a venture capital company? So the companies that you might invest in a venture capital fund, is the ideal path for them to eventually grow enough, become important enough to be acquired by a larger company, and perhaps that company is publicly traded? Or is the ideal path for them to grow enough to eventually go public and become a publicly traded entity that then grows maybe from small cap into mid cap into large cap, and you watch this evolution of it? Or is there not a prescribed path to success?
I think there are many paths to success. Those are two of them. Interestingly, because M&A was not allowed, even in the public markets, innovation has been hurt by that. Certainly in the multi-omic space, that's the case, because these are some of the earliest stage companies in the public market. So they're not making much, if any, money, profits, cash flow, and they're burning cash. And investors have become allergic to that particular group of stocks. That's why there is such an opportunity in them, and why the M&A cycle starting up again will be very helpful. We prefer pure plays, actually, and we are hoping that our companies, whether they're in the venture fund or in the ETFs, that they're not going to be taken out, or not many of them. But one of the most important reasons we want some M&A is strategic buyers give us a sense of what a company really is worth. What are these companies curing disease worth to some of these large biotech companies who really have not been able to do much in the way of M&A? That is when we're going to know the true value, how much they're willing to pay. I think IPOing, in order to keep a pure play going, especially if it's part of the physical and the digital world converging as Tesla is, right? Going public was critically important for Tesla in order to scale into what it has become, and we think it's just begun. So those are two of the most important liquidity events. And of course, we're seeing a lot of companies, especially in the technology area, that end up being very cash flow rich. And many of them are staying private for longer, which is another reason we wanted to start the venture fund, because we want access to SpaceX and Epic and Databricks and some of these companies that are scaling, Anthropic in the AI space, OpenAI, where we've got exposure to all of them, and they're staying private for longer. And we would like our clients to be able to have access to them.
And for the listener, Cathie mentioned a strategic buyer. She did that when talking about M&A, because there's a difference between strategic M&A and financial M&A. Strategic M&A is when a company is bought based on its future prospects, based on what the growth that it could add to whoever the acquirer is, and what the company has already built to that point. Whereas financial M&A is more of a situation where the company needs to be saved, and somebody's buying them because perhaps they've filed for bankruptcy and they're being rescued, which is a much different valuation. And that's certainly not what you're talking about here and what you'd be targeting.
Yes.
Cathie, thank you so much. This has been a clinic on innovation, a clinic on investing in innovation, and frankly, a clinic on patience and understanding that a lot of these themes, no matter how innovative, no matter how quickly they seem to move in the news cycle, they take time to play out. And your example about the internet age, I think, is a good one. And I've talked about this a lot too. Think about when, from birth, the internet, how long it took for us to even understand all the different ways that it would reach through the market. It would reach society, different ways it would reach consumers, and it would transform the way that we do business. It took decades for us to really find all of those use cases. So AI and a lot of the innovative technologies that we're talking about today, this will take some time. And on the part of an investor, it takes a lot of patience as well. So we do these little creative segments at the end of podcasts. They're very short question and answers. The first one that I'd like to do with you is called the word. So if you could only use one word to give advice to a younger investor, what would it be?
Conviction first, and then patience. Conviction based on research.
Okay. I like that. I like that a lot. And then the next one, we'll call it the best or worst trade. What's one trade, either good or bad? It could be one that went really well or one that went really poorly, that you learned the most from over the course of your career?
Can I give you two?
Sure.
Yeah, okay. I learned one in the 90s when I was an analyst on Mexican stocks. And I trusted the economic minister of Mexico that they would never devalue. I will never do that again because he didn't have any control. It's not that he was untrustworthy. I'm sure he believed he wouldn't have to, but the rest of the world. So that's more of a macro call,
Sure.
having to do with lots of companies. But the second one, I have to give it because, everybody focuses on it, even though we bought NVIDIA at 40 cents. And we're still riding it in a number of portfolios because the flagship has to own all of the platforms. So real estate is more dear. And we decided, okay, the Palantir, also Coinbase was another redeploying of the cash. That has done very well. But if we had held just 1% in the flagship, we wouldn't have faced all this flack. So that was an important lesson for me from a branding point of view. I think many people who listened to us from the earliest days, our early days, 2014, 15, 16, and bought NVIDIA, and we've heard from many of them, they're very happy. They didn't care when we got out. They had done very well. But I know that the media, headlines, and so forth, it definitely got me to thinking about our brand and how important it is that, okay, even though 2 trillion, whatever trillion it was, just take it down. Don't take it out, because we still thought it was going to be a good stock, just not as good as some of the other stocks we were choosing.
Well, Cathy, thank you very much. You've been so generous with your time.
Pleasure.
And
Thank you.
I am sure that our listeners will appreciate that even more than I do. So thank you very much for joining us. And we wish you all the best. Hope to have you back on sometime soon.
Thank you so much, Liz. Thank you for all of the research you've done on ARK, on our venture fund. And we're delighted to be partnered with SoFi.
Well, I hope everybody enjoyed that just as much as I did. I learned a ton from her. I want to just do a couple quick takeaways. One of the really interesting parts of when she talked about her investment philosophy was that the companies have to transcend industry lines. So they can't be companies that are just going to affect one particular industry. They have to. It's a requirement in order for them to invest in it, that they have to transcend industry lines. And I think that's a great way to think about innovation and a lot of the technologies that are coming into society today. One of the hot takes, I would say, from her was more of a macro take, and the idea that inflation would start to or continue to surprise on the downside, and that actually interest rates would come down over time as well, which right now, as we're looking at the interest rate environment, is an out of consensus view, and it's on the heels of rates going up. So I thought that was really interesting. And the last thing I would say is we heard her talk so much about AI, but almost AI as a platform for how everything is going to change across different industries. And it's still so much in its infancy. And the two areas that she's actually the most excited about, which will both be affected very much by AI and the innovation that are going to happen in these industries largely due to AI. But the two industries that she's most excited about are transportation and healthcare. And I think that that's a really nice way to look through a lens of what will AI bring, or what does she think AI will bring to society and to consumers in years to come. So rather than investing in AI as a specific theme, these are the companies that will benefit if AI continues on this path. We can look at it through the lens of industries that will benefit and really open up and cast a much wider net of investment opportunities. Thank you so much for listening. We hope that it hit a lot of the topics that investors are thinking about today, a lot of the hot topics that are in media, and a lot of the things that are causing many people to scratch their heads. We look very much forward to bringing you the next episode soon. For more from me, read my weekly column every Thursday on the SoFi blog or follow me on X at Liz Thomas Strat. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Pod People.
This episode of The Important Part was recorded on November 13th, 2024. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part or disclosed by any recipient to any other person without the express written consent of SoFi. Each name of any organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any authority, ownership, or license rights between any such company and SoFi. The content of this program is not a recommendation from SoFi to you or any listener or recipient of this program, and is provided for informational purposes only. SoFi is not providing any financial, economic, legal, investment, accounting, or tax advice through this program, or to its recipient, and you and any person should not rely on this program for any advice. Investment decisions should be based on specific financial needs, goals, and risk appetite. SoFi has no obligation to provide updates or changes to the information in this program. Past performance of any investments mentioned does not guarantee future results, which may vary. Neither SoFi nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program. Any liability for any statements in this program is expressly disclaimed by SoFi. For additional disclosures related to the SoFi Invest platforms described above, please visit sofi.com/legal.